There's a market out there worth more than 10 times the entire global economy. It's bigger than all the stocks, all the real estate, all the cryptocurrencies combined, and most people have never heard of it. It's called the derivatives market. And before you click away thinking this is some boring finance lesson, understand this. Derivatives are either the most brilliant risk management tool ever created or the biggest casino in human history. Depending on who you ask, they're also the reason your pension fund might implode someday. Let's figure out which one it is. The number floating around is $600 trillion. Some estimates push it past a quadrillion. To put that in perspective, the entire global GDP is about $100 trillion. That means this market is 6 to 10 times larger than all the goods and services produced by every person on Earth in a year. How is that even possible? Here's the thing, that number isn't quite what it seems, but the confusion around it is exactly why derivatives are so dangerous and so powerful. Let's start simple. What actually is a derivative? The name tells you it's a financial contract that derives its value from something else. A stock, a commodity, a currency, an interest rate, even the weather. You're not buying the thing itself. You're making a bet on what that thing will do in the future. Farmers have used derivatives for centuries. A wheat farmer in Kansas doesn't know what wheat will cost in 6 months, so he locks in a price today with a buyer. That's a futures contract, a derivative. If wheat prices crash, the farmer's protected. If they soar, the buyer saved money. Both sides get certainty, risk gets transferred. That's the theory anyway. Now scale that concept up, way up. Banks, hedge funds, corporations, governments, all writing contracts on everything. The price of oil, the direction of interest rates, whether a company will default on its debt, whether a mortgage borrower in Nevada will keep paying. Suddenly you're not managing risk anymore, you're manufacturing it. Let's talk about that $600 trillion number again, because it's technically misleading but also deeply revealing. That figure represents something called notional value. It's the face value of all the underlying assets these contracts reference, not the actual money at risk. Here's an example. Two banks make a bet on interest rates. They agree to exchange payments based on a $100 million loan. If rates go up, one bank pays the other. If rates go down, it reverses. The notional value is $100 million. But the actual money changing hands might only be a few $1,000s. So the $600 trillion isn't cash, it's exposure. But here's where it gets uncomfortable. Exposure, when it moves the wrong way, becomes liability. And liability in a crisis becomes contagion. The year was 2008. Lehman Brothers collapsed. The global financial system nearly went with it. The reason wasn't just bad mortgages. It was derivatives built on top of those mortgages. Banks had sliced up bundles of home loans and sold them as securities. Then they created derivatives that bet on whether those securities would pay out. Then they created derivatives on those derivatives, layers upon layers, bets on bets. And because these contracts were private, traded over the counter, no one really knew who owed what to whom. When housing prices dropped, the whole tower started to shake. Banks that looked healthy were suddenly insolvent. Not because they lost money on mortgages, but because they were on the wrong side of a derivative contract with someone who was on the wrong side of another contract with someone else who just went bankrupt. The interconnectedness was invisible until it wasn't. Governments stepped in, trillions in bailouts. Central banks flooded the system with money. The market survived. Barely. You'd think we learned our lesson. We didn't. The derivatives market today is bigger than it was in 2008. More complex, more opaque. Sure, regulators added some rules, more clearing houses, more transparency requirements, but the fundamental structure hasn't changed. Why? Because derivatives are useful, legitimately useful. Airlines use them to hedge fuel costs. Exporters use them to protect against currency swings. Pension funds use them to manage interest rate risk. Removing derivatives would be like removing insurance from the economy. Possible, but painful. The problem is the same contracts that let a company hedge risk also let a hedge fund make leveraged bets. And there's no easy way to separate the two. Let's zoom in on one type of derivative that perfectly captures the absurdity: credit default swaps. A credit default swap is insurance on debt. Let's say you own a bond issued by a company. You're worried they might default, so you buy a CDS from someone else. You pay them a premium. If the company defaults, they cover your loss. Sounds reasonable, except here's the twist. You don't actually need to own the bond to buy the insurance. You can just bet that the company will fail, and someone else will take the other side, betting it won't. Now multiply that across thousands of contracts. You end up with a situation where there's more insurance on a company's debt than the debt itself. It's like buying fire insurance on your neighbor's house, except 100 of you buy fire insurance on the same house. And now everyone has an incentive to see it burn. This isn't theoretical. It happened with Greece during the European debt crisis. Investors bought credit default swaps betting Greece would default. The more swaps that were sold, the more expensive it became for Greece to borrow, which made default more likely, which made the swaps more valuable. A self-fulfilling prophecy written in derivatives. Here's the part that keeps some people up at night. Most derivatives are held by a small number of institutions. For U.S. banks, JPMorgan, Goldman Sachs, Citigroup, and Bank of America hold about 80% of all derivatives exposure in the American banking system. That's a lot of eggs in very few baskets, and while regulators can see more than they used to, they still don't see everything. A huge chunk of the derivatives market remains over-the-counter, private contracts, customized terms. No central exchange, which means when things go wrong, they go wrong fast, and in ways no one predicted. Take Archegos Capital in 2021, a family office that blew up almost overnight. They'd used derivatives called total return swaps to make massive leveraged bets on stocks. When those bets went bad, banks were left holding billions in losses. Credit Suisse alone lost over $5 billion. Most people had never heard of Archegos, but they nearly triggered a broader crisis. So why does this market keep growing? Two reasons: complexity and profit. Complexity because the global economy is more interconnected than ever. Companies operate in dozens of currencies. Supply chains span continents. Interest rates, commodity prices, exchange rates, they all move constantly. Derivatives offer a way to manage that chaos. Profit because banks make money on every contract. They're the middlemen, the house in the casino, and as long as the music keeps playing, they keep dealing. But there's a darker incentive too. Derivatives are opaque. That opacity creates information asymmetry, and information asymmetry creates opportunity. If you know something the other side doesn't, you can structure a contract in your favor. You can hide risk. You can amplify returns. Until you can't, there's a quote often attributed to Warren Buffett. He called derivatives financial weapons of mass destruction. That was in 2002, years before the financial crisis proved him right, but here's the irony. Buffett's company, Berkshire Hathaway, uses derivatives, a lot of them, because in the right hands, they're tools. In the wrong hands, they're bombs. The problem is you don't always know which hand you're in until it's too late. Let's bring this back to you. Why should you care about a $600 trillion market you'll probably never touch? Because you're already in it. Your savings account, your retirement fund, your mortgage, they're all connected to this system. When banks miscalculate risk in the derivatives market, taxpayers bail them out. When pension funds chase yield using complex derivatives, retirees pay the price. You don't need to understand every type of swap or option to recognize the pattern. A market this large, this opaque, this concentrated, it's not a question of if something breaks. It's a question of when, and whether we'll catch it in time. The derivatives market isn't going away. It's too embedded, too useful, too profitable. But it's worth asking whether a market 10 times the size of the global economy is a sign of sophisticated risk management or systemic fragility dressed up as innovation. Because the answer to that question might matter more than we think, and right now we're all just hoping someone somewhere actually knows what's on the other side of those contracts.